Well, 3 positive job reports ahead of the Labor Department's all-important June numbers that come out tomorrow. China shocks the markets with a surprise rate cut while the ECB drops rates to a record low. Here to translate what it all means for you and, of course, your money, James Frischling, president of NewOak Capital. Gosh, where to start? I guess it really is about jobs today and tomorrow for the street, right, Jim?
No, absolutely. I think coming back from the mini holiday we just had, all eyes were on the 3 job-related reports today and leading up to what will be the big, obviously, June employment report tomorrow. But overall, positive news, better than expectations, and setting up for maybe what should be a surprise to the upside tomorrow.
What did you make, though, about these numbers? Because if you look at the Challenger number, you know, planned layoffs at a 13-month low. ADP, I don't know how you feel about ADP. 176,000 jobs added. The estimate was 105, you know, and then the claims. I mean, what do you think here?
I mean, first of all, the ADP number tends not to be always a very good indicator of what happens with the government's much more comprehensive report. So just because that number beat expectations, I guess, shouldn't necessarily determine tomorrow's number. But the fact is the expectations, I believe, for tomorrow, most consensus analysts below 100K, really anemic growth expected, coming off of a May report, which was, I believe, you know, just plus or minus around 70,000. So I think expectations are now at the point where they're so low that I am expecting and to a certain extent hoping for a low surprise to the upside.
Well, May was 69,000. I don't think it's going to get much worse than that. Exactly. We shall see. I know what you're talking about. So, but here's the thing: is the streets thinking at this point that if it's a really bad number tomorrow, that the Fed would step in? We could actually get a market rally off a bad number?
I think right now, on a global scale, you're actually looking at investors expecting central banks and the Fed, particularly here in our country, to be taking action. So to a certain extent, yes. I think if the number is so bad, and jobs, I believe, are one of the key drivers of the Fed believing they need to take action. So if the number is bad, I think that adds a lot of fuel to the fire that quantitative easing, or QE3, is a little bit more imminent. But you look at what happened on the global scale this morning, and central banks are taking action.
Second largest economy in the world, that is China's second cut in a month for these guys. Were you surprised by that number?
You know, I think I was positively surprised on that. Second rate cut in a month since the end of the first quarter, when China's growth was a meager 8.1. And again, most countries would be envious.
I'm only growing at 8.1%. Oh, poor me.
But clearly they're taking action. and I think one of the concerns the market has about a hard landing in China, you watch their CB taking action. So that was a positive surprise.
And the ECB rate cut, I mean, they're pretty much at zero at this point over in Europe. Do you think that that actually stimulates growth over there? Because that's all that anybody wants to see at this point from the Eurozone.
I think the quarter rate point by the ECB cut was widely expected, so they at least delivered on what the market wanted to see. But the fact is rates are so low that driving rates lower, I do think, is somewhat perfunctory. What the market wants to see is the ECB start buying sovereign debt and actually being that lender or that buyer of last resort. But that's something the ECB is not committed to. You look at what the UK just did, the Bank of England, in deploying £50 billion in terms of buying assets. That is, I think, a more powerful play, but something the ECB hasn't committed to doing yet, and actually is saying they probably won't.
Jim Frischling, president, NewOak Capital, triathlete. Good to have you on the show, Jim.
Very nice to be here. Thanks.
All right, Dennis.